Hey everyone, John here. I've been away for a minute. Life happened, you know how this goes. But I'm back, and looking at the markets today, it feels like I walked back into a house on fire. If you check your portfolio lately, it's ugly. We're seeing a massive rotation. The Magnificent Seven are being punished for spending too much on AI, and the headlines are screaming about a tech collapse. But while everyone is panicking and hitting the sell button, I'm looking at this as a rare moment of reposition. Today I want to talk about the reality of this crash and the five specific companies I'm loading up on while they're on sale. We're in the middle of what Wall Street is calling the Great Rotation. Investors are pulling money out of tech stocks and moving it into boring companies that are actually generating cash now. This creates a massive disconnect. High quality businesses are being sold off not because they're failing, but because the big money is shifting seats. This is where this is where we, as individual investors, have an edge. We don't have to report to a board every quarter, and we can just buy the quality and wait. Look at companies like Cat up here on the screen, soaring, like while companies like Microsoft are being gutted. Now, Cat is a quality company, but it should not be, worth like $730, while Microsoft is being gutted. It feels like it's important to remind ourselves at times like these that the numbers on the screen represent real businesses. These businesses are being sold for liquidity and not because they're failing, and that most of the times it is good to buy the dip rather than the peak. First up, we have Microsoft. Just had its worst quarter since 2008. Think about that. The stock is down 24% in Q1. Why? Because they announced a 146 billion capital expenditure plan for AI infrastructure. Wall Street is terrified they are spending too much. But if we look at the numbers, revenue is still up double digits, and their backlog of business is over $600 million. If the market wants to hand me one of the world's most important software companies at a 20 to 30% discount because they're investing in their own future, I'll take that deal every single time. Next is Meta, effectively a monopoly in the social media space. Like Microsoft, Meta is being punished for spending billions on AI. But here's what some people might be missing. Their AI tools, like Llama 4, are already making their ads more profitable. Ad impressions are up and the price per ad is rising. Zuckerberg is investing in the future of his company. We're seeing a valuation gap here that is starting to look like a generational bargain for this great company. I'm not only looking at tech though. For number three, we have Zoetis. Tech is volatile, so it is good to have an anchor, and if that anchor is discounted, then that is even better. Zoetis is the world leader in animal health. Even in 2026, with inflation being as sticky as it is, people are not cutting back on medicine for their pets. It's a trend that it is only going to keep growing, that we treat our pets like family. Zoetis is facing some competition in the US, but their international growth is carrying the weight, which is why their stock has been trading down during this time. It's a slow and steady compounder that protects your portfolio when tech is crashing, and I find the stock attractively priced, though I might wait for it to drop just a little bit further before I actually start buying. Number four is the aggressive one, SoFi. This stock has been a roller coaster. It hit $30 in January, and now it's sitting at $18, which is a 45% drawdown. Sorry about that. However, the business has never been stronger. They're finally GAAP profitable, they're adding a million members a quarter, and they're basically the face of fintech at this point. If you can stomach the volatility, I believe that SoFi at these levels is looking attractive for the long term. Company number 5, e.l.f. Beauty. When people feel like inflation is out of control, they stop buying $60,000 cars, but they still buy the $10 lipstick. The e.l.f. just reported their 28th straight quarter of growth, which is insane, and they're eating the lunch of legacy brands like Estee Lauder. It's high growth, high margin, and perfectly positioned for a shaky economy. This is yet another roller coaster ride from $6 to 220 to 60 to 130 to 60 again. I bought a lot of the e.l.f. stock during the tariff drama, and even though I should have sold some of it when it hit the 120 to 130 mark, because not because I think that it can go higher, but because it had grown to be about 10% of my total portfolio, which is a little bit much for me, especially for a high risk company like e.l.f. But I must admit that I got greedy and I lost all my gains for that. As we live, we learn. I'm not picking more of this stock just now, but I have my position fully built. I'm not selling either. I think that it is a very good company and that it is going to grow even more than it is now. The bottom line, red days are when the work gets done. It's easy to be an investor when everything is green. It's a lot harder when the headlines are screaming crash, we're all going to die, run to the hills, etc., etc. Turn off the noise, look at the balance sheets, and stay rational. I'm glad to be back in the seat. I want to hear from you. If you could only buy one of these five stocks during this sell-off, which one would you choose and why? Drop a comment below. Don't forget to subscribe so you don't miss the next deep dive, and I'll see you in the next one.